This is video 3 of 3 covering the class notes for chapter 1. In this video, we begin at the top of page 7 and go to the end of the note packet on page 8. We'll start here with trends in cost accounting. So cost accounting, as most of the rest of the world, has shifted and changed a lot in recent years, largely because of the evolution of IT and technology. Increasingly, record keeping has become automated, it's become more expansive, where things that we used not to track are now more easily tracked and recorded. As we've begun to collect more information with greater ease, there has been a shift to focusing on using that information in controls to inform our controls or to identify gaps in controls. So there's a change in the information we're collecting and what we're doing with that information to some degree. Much of this change, obviously driven by the technology available to us, also driven by the demand for cost information. As it's easier to collect it, there's been a greater demand for different types of information. Additionally, we've seen a lot of development in the products we make and the processes we employ to make those products, where increasingly machines or automation are used even at that production line level, which makes it easier for us to generate and capture different types of information. And there's a greater demand for it because we're maybe trying to be a little more predictive of what the market will want in terms of our products. All of those factors, the greater demand, the differences in the technology available to us and how we use it, and the information we can track, has led to a pretty rapid evolution of cost accounting. One of those evolutions in cost accounting, but just more generally in business information systems across the board, would be enterprise resource planning. That's to thank for a lot of the different variations and scope of information that is now more accessible to us. An ERP is an integrated information system across the entire organization, typically, where basically it's one information system that links all these different functions and departments together into a single information system, where the data that it collects is more consistent across these departments, all kind of speaking the same language. It's linked and integrated together to where I can track, maybe say I was a car manufacturer. I can see the cost and all the activities relating to a car on the production line. And I can also track those costs once they get out to like the marketing and sales department or distribution, where I can see the costs associated with that specific car as we try to get it to the dealer who had purchased it. So it allows us to follow that information across the value chain a little bit better. The information that it provides is accessible, it's easy to access, it's this organizational level, and oftentimes it's more useful because I can link it up between all these different departments. It's already in a more consistent form. It provides more information, better information, more comprehensive and thorough information, easier to use information. As we begin to collect more and more data via ERPs and any of the other systems that we have in place, we have a lot of data. So with the ease of collecting data comes, you have typically a lot of data. So it can be easy to drown in a sea of information. So when it comes to making sense of large quantities of data, data analytics can be very helpful, which is where we basically analyze a large quantity of data to make sense of it. When we're trying to employ data analytics to make sense of a large quantity of data, we have this framework to guide us to best make use of it. So when it comes to using data analytics to make sense of a large quantity of data, the first thing you want to do is understand what you're trying to do. What question do you want to answer? Identifying and specifying your question allows you to determine the data that you would need to answer that specific question. Once I know what data I need, I can typically identify where I should be looking for that data. Who would have it? What would it be titled? What would it what would it look like? I now know what data I'm seeking. Once I get that raw data, just unclean data, just in the form that we pull it from the data system, how do I take that data and actually do an analysis that answers the question that I originally posed? So, how should I analyze it? What tools do I need to use? What kind of analyses or tests should I run? Um, how do I take that data and make sense of it? How do I do some kind of evaluation to make sense of it? I can make sense of it, but now I need to know how to take my understanding of that data based off of what I found in these analyses, which can be technical and complex. How do I simplify that to make my case for my answer that I've found through my analysis? How do I tell others about my findings in a way that makes sense to them, that simplifies the analysis? How do I best communicate it and persuasively communicate it? Oftentimes, you'll see visualizations being used here. Now that they don't have to be a visualization if the data or your analysis, I guess, is simple enough. But oftentimes, the analysis are complex. Providing a visualization can sum up a lot of numbers in an intuitive way. So, in the example used in the book, it was about choosing a manager to promote based off their profitability. Um, they used a variety of tools as examples in the text, from heat maps, which just basically highlighted those who were the most profitable, managers who were the most profitable at their prior district, that is. They had a bar chart where basically they had manager A, B, C. Here was their profitability. Or, I'm sorry, yeah, we'll say that's their profitability. Here was their revenues. So if you wanted to assess how they used their revenues, like how profitable they were as a share of their revenues, here A had changed that actually. A, B here had the most in profit versus A, which is just slightly lower. But this was the amount of revenue it had. Only about half of what it had in revenue was converted to profit. Whereas A, its profit here is not much lower than its revenues. So they retain more of their revenues as profit. So while in absolute terms B was more profitable, A seems to be operating more efficiently, which might impact your decision if you're looking at someone who you're putting in charge of, you're putting in a position where their ability to manage costs effectively would be important, because here A is controlling costs better. But that's a visualization that could communicate information about cost or about profits relative to revenues. Then there was one that was a scatter plot with revenues being X, profit on Y. So here it's also kind of juxtaposing the relationship between profits and revenues. It's like I have this outlier up here where the revenues are lower, but their profits are higher than many of them with much higher revenues. So it would take into account revenues when you're looking at it alongside profitability. It helps us see the outlier. That could be an effective way of communicating profitability as a share of revenues, or profitability in its relationship to revenues, if that was important. The heat map would just highlight whoever is the most profitable. The best way to communicate the answer to your question, just kind of depends on the audience and on the data you have and on the case you're trying to sell. So that's how you could use analyses yourself to use data to answer important questions and communicate your findings. Another resource that has become popular to use with that large amounts of data to employ to make sense of large amounts of data would be artificial intelligence. And AI can be useful in making sense of a large amount of data, but there are important limitations to bear in mind. Essentially, when using AI, you should always remember that the model and its responses will only be as good as its foundational training, as the foundational model. It's only as good as what it was taught. So if you are trying to use your data, if you're feeding your data into AI, but that model was built on training data that reflects an entirely different set of circumstances than the one you're operating in, the response it gives will be a response premised on other circumstances. And that might mean the response it gives isn't really relevant to the set of conditions you're operating in, and you can't really use its findings, at least not beneficially. Another concern would be accuracy, the accuracy of the response it gives you. We all know AI can hallucinate. That's particularly true if the information that it was trained on was maybe incomplete. It didn't really consider the entire span, or didn't really feature the entire span of causes or results or circumstances. It could also happen if it's inaccurate. So it's fed training data, but there's a possibility the training data might have been misrepresented, or maybe maybe there were typos that are really influential. It could be bad data that it was fed or that it was trained on. And then the answers it will give you will be inaccurate too. It made sense, or its understanding is flawed, so its responses are flawed. So say though that you think the training data is solid, that it's a good proxy for the set of circumstances you're working in, you don't have concerns about its comprehensiveness or accuracy, you think it's a solid model. Even then, you should bear in mind a few risks that you face when utilizing AI, when you're feeding your data into AI. One is the potential for copyright infringement. So the model might have been trained on data that included another party's intellectual property. And the response it gives you might feature that intellectual property that you do not have legal claim to, such that it could lead you to be in violation, or it could lead you to infringe upon another's copyright or intellectual property. So there's concerns about that. That would be an issue with the response you're given. In the act of you uploading that information yourself, though, there's concerns about, one, you providing AI with information that was supposed to say in the firm. Basically, you disclose some proprietary information when you're uploading the data to AI, especially if the AI you're using is not one that's internally managed by your company. So you could feed it some trade secret that you did not intend or that the company did not want disclosed publicly, which could harm the value of the company. Or you could violate certain laws, regulations um, about disclosing data publicly, about the data that you have. If you're uploading the information and there's some kind of legal statute or regulation that prohibits you from disclosing certain types of information, then you could run into legal trouble. So, an example, if you're a doctor, you got some patient data that's not de-anonymized, I'm sorry, I cannot say that. If it is not anonymous, and you upload it, you could be in violation of HIPAA. So those are concerns. Think about the data that you're uploading. Think about the responses you're getting. Make sure they're in compliance with the laws, regulations, ethical concerns that govern you. Talking about ethics, we'll discuss concerns about ethical issues in accounting for financial accounting, but also more specifically for cost accounting. We likely remember that I'm concerned about ethics in financial accounting, right? Because in financial accounting, you've got these external users who don't have inside access or inside knowledge, and financial accounting information is only useful to them if they can trust that information. Violations or ethical violations lead to mistrust of financial accounting reports, which leads to the devaluation of accounting overall. In cost accounting, though, there's still ethical concerns in that financial or cost, bad info can be harmful. It can be detrimental. In the case of managerial accounting or cost accounting, bad info from cost accounting systems can lead to bad decisions that negatively impact organization value, or bad cost accounting info could maybe as like a say that it was a factor in like a manager's estimates, like management's making some estimates that will be reported for financial accounting purposes. Bad cost info that goes into those estimates becomes bad financial accounting info, which leads to harm to investors or lenders if the difference is material. So, ethics still matters in cost accounting, even though it's reported internally to managers. So, why are ethics important? Why are we considering this? Why is it such a threat? It's a threat because of the pressure that accountants can face. So, accounting information, financial accounting information in particular, is used as the basis for management evaluations, which means that there's consequences to managers' career prospects, to maybe their bonuses, their compensation. So managers have a lot riding on that accounting info, and they may try to influence accountants to report in ways that are more favorable to them. So there's a pressure to misreport from superiors, from management. And if you misreport, that information can lead to negative consequences for other users. So in a financial accounting world, it can impact shareholders who might not have invested had they known that revenues weren't as high as the income statement said they were, or whatever the difference is. The Institute of Management Accountants, I think that's what the IMA stands for, might be managerial accountants, is a professional organization, and it addresses accounting ethics here, the ethical concerns and guidelines for cost accountants specifically. It encourages cost accountants who are facing some kind of ethical dilemma to discuss their dilemma with some immediate supervisor who is not involved in the conflict, encourages them in that discussion to clarify the issue and with that disinterested party or with the unbiased party so that you can hopefully find a resolution. And if you're in a position where there's no resolution forthcoming, it encourages you to seek external legal advice by consulting an attorney about what your rights are in this situation and what your obligations are. It reminds cost accountants that they have a responsibility to maintain, in all circumstances, their competence. They are responsible for acting competently, for knowing how to do their jobs and doing it well. They're responsible for maintaining the confidentiality of their clients or of their employers, so they cannot disclose confidential information. They're responsible for maintaining their integrity. They should be objective and truthful, and they should maintain their credibility. They should protect their credibility. They should strive to be fair and objective, to be accurate, to report complete information, and to report it in a timely way. And when they have concerns or caveats about the information they're reporting, they should disclose that too, to ensure that users can assess it accordingly. If there is a threat to upholding any of these responsibilities, they need to address it. Maybe that means seeking a resolution. They can discuss it with someone. They can come to an agreement about how to handle it appropriately. But if no resolution can be reached, they may be left with no choice but to resign. So if they cannot uphold those standards in the current circumstances, they must uphold those standards by removing themselves from that circumstance. Accountants' ethics are not just something that's been addressed by professional organizations, though. The Sarbanes-Oxley Act of 2002, or SOX, also addresses the ethics of accountants as a matter of law. In particular, this is mostly applicable to financial accountants, but we'll discuss it here anyways. So SOX, you see here it's born in here, 2002. It was a byproduct of those late 90s, early 2000s financial accounting frauds and scandals. So think Enron, WorldCom, those kind of scandals. Massive frauds, massive scandals that fundamentally weaken the public's trust in financial accounting info, because the financial records or the financial statements that were being reported were being misreported. The information was not valid, essentially. That weakening of the public's trust prompted legislators to act in a way to improve accounting information and to restore the public's trust in it. It did so by legislatively establishing management's responsibility for financial statements and requiring them to disclose frauds to to the auditors, to audit committees. So here, a few key requirements. It's instituting their responsibility. CEO, CFO, they are ultimately responsible for the financial statements and they're required to sign off on them. It explicitly establishes management's responsibility for internal controls over financial reporting. So even if there is an error in some accounting system, management is still legislatively responsible for that as well. It also requires disclosure of them. If they have any knowledge of any kind of fraud that involves management, it must be disclosed to the auditors and to the audit committee. It's like a subcommittee of the board of directors. So there's legislative um, legislative concerns about ethics, like that has been addressed in matters of law. Okay, that is the end of my chapter 1 class notes. Make sure to let me know if you have any questions or concerns when doing the homeworks or the quizzes, or even any concerns when you read through the note packet or the chapter. Thank you.